Oh, perfect. So, hi, Rob. Welcome to Venture with Grace.
Hey, how are you?
To start off the show, I would love for the audience to learn more about you. So, obviously, you have worked at Goldman Sachs, Bain, and prior to starting your own career in venture, you created another company, which is like a consulting business. And I just saw that your company already raised Series F. So, can you share a little bit more about what did you learn from the entrepreneurial era to building a fund?
Of course. Look, the reality of starting a company or a firm is you're basically saying that the world does not have something that it needs. And in a company, that's usually a feature, a product, a service. And in the investment firm context, you're somewhat just saying that you think that the existing landscape of investment firms is insufficient. So I think there's a strong similarity in that way. Um, and you are also, by extension, trying to create something new in the world that functions differently. Um, and there are a lot of in both the company and the fund context, there are a lot of things that are fighting in favor of that not coming to be true. Basically, there's a lot of kind of embedded and implicit pushback from the world, and that's your competitors trying to sell products that compete with yours. It's all sorts of different things that sort of make it difficult to realize your vision. And then obviously there's always just kind of um, the sheer gravitational force of kind of runway and all the things that might interfere with your success. So I think, look, it's now been almost 12 years trying to turn Catalant into something real, and I think we've certainly at this point worked with a very large fraction of the Fortune 100 and have kind of on the order of $100 million of top line. So that's kind of been made a success, and I think we're starting to see the same kind of green shoots at Asymmetric, that founders are wanting to take our money and work with us, that LPs are having a great experience and returning for subsequent funds. I think the mark of success, whether it's restaurants or car washes or venture capital firms or all of the above, is do people use the product once and then want to come back and use it again.
Totally. I want to quickly check in. Can people hear us? One of the I guess like Chloe said, like maybe just me. I cannot hear you guys. Anyone else?
Oh
Can
no.
anyone? I hope everyone can hear us. This have happened in the past. I was like, there's one person cannot hear, but like everyone else can see us. But hopefully, this is just one person. I can hear everything on my end. Okay. Anyway, so we can keep going. I assume this is fine. But hopefully you can hear it, Chloe. I want to like basically double click on one of the things that you just mentioned, like, for a venture fund to exist or like a new venture fund to exist, like, you're supposed to think of like what's not existing in the market already. So what were the things that you feel like you saw that was not addressed by the current
Yeah.
funds? Not current, but like back in time, the current funds.
Yeah, look, when we conceived of this firm in fall of 2020 and spring of 21, certainly the New York ecosystem was significantly less well developed than it is today. And I like to believe we've played a core part in kind of maturing the New York ecosystem. I think the feeling I had was, we were very lucky at Catalant and Hourly Nerd to have amazing early stage investors from Highland and Greylock and Mark Cuban. But the reality is both markets felt as if they had too few firms focused on writing checks at the earliest stage. And not only writing checks at the earliest stage with kind of a spray and pray approach, but also being capable of helping companies as they matured through the process. So our vision and what I think we've successfully set out to build is a firm that writes checks at the earliest stage in New York and Boston, exists investing in almost exclusively B2B companies, writing checks kind of on the size of $1 to $5 million, and really partnering with founders in a day-to-day, week-to-week basis to really grow companies in a way that ordinarily you don't see sort of venture capital firms have the resources to be able to pull off.
I wonder, so like some of the company you have invested, I believe, are in the Bay Area. So like I saw that you invested in like Gone, which is like a Bay Area company I consider. So like for oh hi. Okay, perfect. Uh like okay, so Brandon can hear I guess like okay, perfect. Um okay, so I think Chloe can hear now. Anyway, sorry. So I wonder when you're thinking about like the geography, like what are some things that you would take into consideration on like, what is considered like a New York based fund, since I feel like everyone's investing in globally, not globally or like just like geo agnostic to a degree. So like I wonder how is like a New York firm different from like the Bay Area firm. I know that maybe you guys are focusing on mostly in New York, but
Look, I think the reality is most firms are going to do deals where they find deals. You can have a geographic focus, and then what is your overall aperture? So would we do a deal in, Southeast Asia? Probably not, because there's a lot of ways that ecosystem might function differently from ecosystems that we know. And obviously it's difficult for a team based in New York and Boston and California to be able to be helpful. So there's where we spend active time in deal pursuit, and that's really New York and Boston. And then we also have investments in Tampa, Florida, and quite obviously San Francisco and a bunch of other places. And most of those, almost everything we do tends to be the result of a warm connection or referral from somebody that we knew, principally in most cases, one of our existing founders. And that has brought us to San Francisco. And I think we've done well in a niche we've been able to carve out there, which is founders out there. Obviously, there are 5,000 great venture firms in the Bay Area. I think our value prop is also a little unusual out there, in the fact that we're 3-hour time change and 3,000 miles away doesn't hurt us as much as you might expect, because we also, given we have the kind of core group of companies out there, we're in the Bay Area a lot. And I think when you think about how a firm defines itself, people typically will tell you, I'm a blank-based firm, and that means they're going to spend most of their kind of outbound deal development activities there. But any of us are obviously going to do a deal in a place that, we're excited when we meet great founders.
Totally. I want to learn more about like, so since like I saw some of your portfolio are like, pre-seed and seed, and then you guys have also invested in Series A and Series B. I wonder, when it comes to portfolio construction, what's kind of like your thought process to it when you're, building?
It's sort of the same argument as the geographic argument, which is, to have coherence and be able to present limited partners with a product that kind of slots well into what they think about it, and also be able to build sweet spots and muscles that make sense. You want to do 75 to 90% of what you do in your core. And for us, that's pre-seed and seed. So if we looked at the dollars we've deployed in Fund 1, I think solidly 90 to 95% of the dollars are pre-seed and seed. There are also times when a wonderful opportunity presents at the Series A that we've gotten kind of unfair access to, and we're also going to do those deals because we've done all of the work required to get there, to not do something because we have kind of an arbitrary, it must be 100% pre-seed and seed. Wouldn't make sense, in the same way that we just led our first investment in Fund 2 in the UK. And so I think it's kind of a 90-10, 80-20 rule of stick to your knitting, except for the rare occasions when you have some sort of edge or advantage to be able to do something a little bit outside the core sweet spot.
I wonder, so since like I feel like a lot of people are focusing on like the SaaS or like B2B software space, like when you're thinking about creating your own fund, like is there any particular niche that you're most excited about? And like, since like right now, especially I feel like the AI ecosystem, like every company is towards something AI. What's like I guess like if you have like a particular niche that you are emphasizing on?
Yeah, it's a good question. So we certainly believe that large language models are an important development. We certainly believe that we are in a very large AI bubble. I think where we've focused most of our investing, and we're actually about to publish, or what I think is a pretty interesting piece of content about this, is there's an intersection of kind of large language models and vertical software targeting very specific niche areas where you can generate truly outsized value, and you can also do it in a subsector that has very little competition. So if you think about why, and I was recently in Fortune Term Sheet talking about this, why we think at Asymmetric a lot of people are going to lose money in AI is, if you think about the average prospector for gold in California and Nevada and other places in the 1840s, and 1850s, the average prospector actually didn't really make any money. It was a small number of prospectors that made a tremendous amount of return. And the way to make a tremendous amount of return is you need to be early, and you need to be somewhat off consensus, and you need to be right. Because if you're only early and right, but you're on consensus, a lot of your excess return gets creased away by other people sort of competing for it. And if you think sort of stupid framework, the way that natural gas wells work, so you drill a natural gas well, there's basically a straw that goes down and sort of sucks up the gas. And there's one kind of, within the shale play, there's essentially one big pool of natural gas below. If you are alone, you get to extract all of the gas. If there's two people, then you split it 50-50. If there's three people, you split it a third. And so you have to, if you're going to make excess returns for your LPs, you can't be in obvious spaces. You have to be in non-obvious spaces, because not only do you end up sharing the pie, and the pie, taking the analogy of natural gas, the pie is customers and airtime at conferences. You also have increased capital intensity. So it's not only that you get 1/3 of the oil in that, or the natural gas in that play, it's also the fact that you have tremendous more competition for talent. So if you're the only person at a natural gas play, you can probably pay your workers less than if there's 6 other people competing for the same talent. So you end up with lower revenue, higher costs, and relative to the same amount of invested capital. Obviously, the returns will be worse. So we think about that a lot. And so we go looking for kind of weird niche spaces, like how long-term disability and workers' compensation claims are reviewed, doing that with AI, or how airplane wings get translated from blueprints into actual airplane wings using AI. And those are niches where, we might not back the 1 of 1, but we're probably not backing 1 of 6 or 1 of 10. We're backing 1 of 2 or 3 at worst.
You mentioned so I guess when I was looking at your portfolio, so I saw that you have invested in a robotic company that's acquired by a truck, self-driving truck company, and then you have invested in basically a remote work platform, and then you have invested in just workforce productivity tools. So I guess you invest in a diverse group of companies. I guess when you mention companies that are undervalued, where do you typically look? And then since you mentioned a lot of the current portfolio companies are introduced by existing a previous, or basically the company that you have already invested in, I wonder, how did you find the first batch of company back then to kind of make sure the quality of the founder are repetitively great?
Yeah, a lot of the way that a venture firm gets started, you have a core group of relationships from what you did previously. For me, that was obviously Catalant, but also the 4 years I spent as a private equity investor before finding Catalant. And the way you kind of begin the snowball rolling down the hill is you invest in people that you worked with previously, people you went to school with. And so if you track through a lot of our first 5 or 10 investments we made out of the fund, they were either co-investments with some of the amazing firms that bagged me at Catalant. That's General Catalyst and Highland and Greylock and Mark Cuban and Salesforce Ventures and others. People that I worked with at Catalant, people that worked for me when I was CEO of that business. And then you can almost trace every deal we've ever done through those layers of concentric circles. We now have 60 or so advisor partners that are folks that maybe we worked with in the past that aren't yet founding companies, that collaborate with us to go find deals. So this deal that we just did in the UK was one that one of my colleagues was good friends with somebody who'd been at a very large public tech company, US-based company in the London office. She had a colleague that started a company. We got to know him over the course of 18 months. And then finally, most recently, we sort of, in the midst of a routine catch up with him, teed up the fact that we'd love to invest, and a deal happened relatively quickly. And I think that's basically how the sausage gets made in early stage venture capital.
When you are selecting the advisors, are they domain experts, or are they more of tier 1 VC funds, like you just mentioned, they would be the advisor?
No, virtually all of them are operators, some at very large companies, some at small, some are founders. I don't think we have any of them who are actually active venture capitalists now.
Got it. Would they be providing deal flow, providing a part of the deal flow, or more of vetting kind of thing?
Way more on the providing deal flow, but also there's a little bit of them vetting deals. So it's kind of a mix of the two. But I think we primarily see it as valuable because they surface deals that we end up kind of looking at doing, and in a lot of cases do.
I wonder, when it comes to building an effective program, are you thinking about maybe incentivize people through like a carry structure, or like are people just like primarily doing it because of like they really believe in the mission, or they're like the LP of the fund?
Yeah, look,
Obviously, you don't have to share everything. Like you share whatever you feel like comfortable with.
happy to share. So obviously our LPs have a very strong vested interest in referring deal flow to us. Our advisor partners get involved for a handful of motivations. I'd say first and foremost is a lot of them are thinking about down the road, do they want to be a VC, or do they want to start joining some boards? And so having exposure to companies that they don't work for, I think, is a very interesting aspect of that. The second thing is a lot of our advisor partners are people that might be considering changing their career. So if they're currently at a very large company that they've been with for 5 or 8 years and has gone public, I think for a lot of them, it's top of mind to think about, what's potentially next for them career-wise. And that's a motivator. And then I think a very small fraction of it is some sort of self-interest economically, where we actually offer them the opportunity to co-invest with us if we end up doing a deal. And then we actually do give them carry. And we importantly don't give them carry in the specific deal. We actually give them carry in the entire fund. And the reason we do that is we want, if you're an advisor partner who's done the work to sort of surface a deal we end up doing, when you have the opportunity to directly co-invest, and we're not going to put a cap on that. So that gives you the opportunity to kind of reap the benefits directly, but then you're truly in the family at that point, and we want you to feel alignment. Let's say you found company A for us and company B has a question that's, germane to your topic area. We want you to be, happily well aligned to help with that portfolio company as well.
Totally. I wonder, when it comes to like fundraising in general, obviously we're not talking about specific parts of the, I guess in general, like what's your suggestion for like first time fund managers, since I feel like there's a rising group of people trying to fundraise as like a first time fund manager. Obviously you have done it successfully, raise a $105 million fund, which is very impressive for a first fund. What would be your suggestions for people going in, since a lot of people are I feel like a lot of the LPs on our show have suggested people should go down the niche path, just like being the niche of a niche. But would you agree on that school of thoughts, or like, do you experience something differently?
I think that's probably the best advice, particularly for somebody who has niche expertise. So we often talk about cybersecurity, for example. None of the 6 of us who work at Asymmetric are cybersecurity experts. And if we were to brand ourselves as a cybersecurity niche firm because we felt it was important, I don't think we would do very well. And so there's a difference of if you have authoritative ability in a niche, and by the way, niche doesn't only mean cybersecurity or biotech. It could mean a geography. It could mean a certain type of business model like marketplace or software as a service. I think we would, if I was forced to explain our niche, I'd say it's businesses that are somewhat technical, that use a piece of, exogenous technological change to hinge into a new value proposition. And then we would say we are unique in that we can, better than most other venture firms, or probably almost all of them, drive go-to-market results through both our firsthand experience growing companies as well as our network of advisors and limited partners. And that is a capability that is relatively unusual in the industry, even if we are investing across SaaS and marketplaces in New York, Boston, and San Francisco, and London. We define ourselves, there's almost 6 or 7 degrees of freedom you can have as an investment firm. And if somebody said, we're going to do all stages and all industries and all geographies and all business models, I would say that was not a very good strategy. So I think your way of defining yourself niche-wise is you cut down things you don't do. So for us, we don't do robotics, we don't do crypto, we don't do biotech, we don't do hardware, because those are all spaces we don't really understand. And I'd never enjoy doing something that you're sort of not differentiated in.
I wonder, so when it comes to like deal sourcing, so like a lot of the newer funds are like really emphasizing on leveraging technology, like especially AI, to build an edge in that domain. Like from deal sourcing perspective, as like you definitely mentioned, some of it would be coming from like the advisory people from the firm. Is there something that you would do differently, like versus like a traditional fund that like people may not know of?
Yeah, look, a lot of firms spend a lot of time doing outbound sourcing. I think this is probably one of our biggest areas of disagreement with the market. We don't see a ton of value to doing very much time with outbound sourcing. Our assumption is if we can go outbound and you haven't necessarily found an existing investor, we're probably not just going to show up on the scene and then over the course of a week or two figure out whether we want to invest and at what price. I think we tend to prioritize situations where we can get to know the founder over a particularly long period, and just be able to be really choiceful about kind of how we align with them around their vision and whether we can get to a point where they want to do something that we think makes sense to us. And that's where I think a lot of the challenge sets in when you have these kind of shotgun deal processes and you meet somebody and give them a term sheet 5 days later. You haven't had really the opportunity to see how they work and where the business is potentially going to go, and think about a lot of the conditionalities or the hypotheticals. If we find out fact A, are we going to build business B? Those are hard to assess over the course of a week or two, and that's why almost everything we do is the result of kind of a multi-quarter or multi-year relationship.
Can you walk us through maybe like using one deal as an example of like how you meet them to the evaluation process throughout the fund and the throughout the course of like maybe a quarter or like a year of knowing them? Like, what did you find out about the company before putting in the capital?
Yeah, look, I mean, 90% of the process is about evaluating the person, because the ideas change, but the people are, relatively fixed. They might improve a little bit, but we've never really invested when we don't believe in the founder. So the best business idea run by a person that we don't want to be in business with is not something we're going to do. And that took a lot of discipline, because I think when Sam and I were starting out, we met with a lot of really compelling ideas, but we thought, do we really want to be in this business with this person for the better part of a decade? And obviously you can sort of change management, but that's really difficult in the startup sense. It's not like changing, management at an existing company, because so much of these companies is kind of inextricably related to the founder and their vision. And then I think the last kind of 10 or 20% is this a market that we think can create a company that we're interested in backing? And then there's a tiny little fraction, 1 or 2 or 3%, that's kind of structure of the deal and the security and the prices. But those are never really top for us. And then, so those are the three things you think about when you're evaluating an early stage investment. At a later stage investment, sometimes seed, sometimes Series A, you also have to think through the traction, how well the company is performing, or basically, colloquially, are the dogs eating the dog food? We don't have to do too much of that, because in most of the time we're investing at valuations that are very much early stage, sort of associated with pre-revenue, sort of pre-traction companies. But obviously, if you're going to analyze how the company is performing, you want to see customer retention at a very high rate. So if people buy dog food this year, they're buying much more dog food the following year. And I think you also just want to see that the customers are using the product in the way it's intended. You can create a lot of revenue while the customers are using the product in the wrong way. And in most cases, I think I've found that that's not very sustainable.
I wonder, so when you are thinking about like evaluating the founder, or like just like trying to, since like a lot of the times that you invest in them are like traction, or like basically, I wonder what would be like the stable question that you use to evaluate the founder? So like what would be the particular question that you would ask to filter out like the people?
Yeah, what we want to figure out is if we and they believe we're going in the same direction. And to my earlier point, the best founder that thinks that we're going in a different place, thinks we're ultimately parking the car somewhere else, is probably not somebody we're going to have a good time partnering with. So if we're starting on a road trip that leaves from New York, and we think they're an amazing driver, but they want to take the car to San Francisco, and we think the car should go to Dallas, that's probably a situation that's going to be ripe for conflict at some point. And in some of those cases, they might actually be right. In fact, probably in a very disproportionate share of cases, they're actually right. But if building a car that's going to San Francisco is not something we're interested in doing, then that doesn't really doesn't make sense for us to be their partner on the journey, because we probably won't be actually all that helpful.
I wonder, so when it comes to like building up your own team, maybe we can jump a little bit into like prior to your like the founder days, like how did you kind of like start the company? And then I feel like from my understanding, it's like a consulting firm that's like now like at the beginning you guys serve like SMBs, and then like in the end you guys serve like Fortune 500. Can we maybe like chat a little bit more about that experience when you were first like getting the team together to build that company? And then I would assume like it's like, I guess like, yeah, like I would love to learn more about like your operational experience there to like what
Yeah.
is like transferable to building up your own team at your fund.
Yeah, look, I think the thing that probably is resonant across both company operating and venture capital fund formation is you want to do things at low scale and test them before you make big investments behind them. So at Catalant, when we started as Hourly Nerd, we worked with small businesses. We worked with small businesses because we had to build up a core base of sort of experts and people to be able to do the projects, because if we turned on Pfizer or General Electric or Anheuser-Busch on the first day, they would have had a bad experience. And we wanted to test and validate a lot of things about our operating system before we did it on a big scale. And so when we ultimately, I think we started the company in February of 2013, we only started really working with enterprises in a meaningful way in kind of the summer of 2015. It took about 2 years to really build and perfect the model. At Asymmetric, I think certainly Sam and I went through a pretty similar process, and then augmented by Nancy and Maddie when they joined, where we wanted to validate that basically software businesses was where we wanted to be, that basically Boston and New York were where we wanted to do most of our investing, that investing at the pre-seed and seed offered kind of the best risk-adjusted return to our investors. And that was a process that we sort of engaged in over the course of months and quarters of seeing the individual deals, watching how they perform, seeing from who they raised money, and trying to kind of hone our sense of when you get to be a good VC, I think they're often criticized for it, but the best VCs are really good pattern matchers, and they're really good at identifying, if this is the set of facts, this is the most likely outcome from that set of facts. And we had to kind of hone our capabilities because none of us had ever been venture capital investors before.
Totally. How do you think about like in terms of like building up the like support system to support the existing company existing founders, and then I guess like in what cadence do you kind of communicate with them to like help them grow?
So it's mixed. Look, we have 30 portfolio companies in our core, and each of them is in a different program with us. Some of them we speak to almost daily or weekly. Some of them we speak to only quarterly. What we like to do is tailor our approach to exactly what the company needs. And Michelle Spitzer, who leads portfolio and platform for us and is based in San Francisco, is kind of the air traffic controller, the triage of that, where she is herself in most cases kind of the first line of defense, or the company front door. And she's both triaging and assessing what the founders need, whether it's somebody else on the team or one of our advisor partners or a third party or something that she can solve herself. And then she does a very good job of kind of pulling people on our team in as the situations require. And I think she is a super person in the extreme. And the fact that we, I think at this point, have between the core and the Discovery Fund, 92 or 93 companies, and she's able to kind of traffic cop against all of those is incredibly impressive. And then look, we all have areas of expertise. Sam and Maddie came from very rigorous high-end investing world and are very capable of thinking through M&A and financial forecasting and additional capital that people might raise for a variety of things, and also kind of high-level strategic questions. And then, Nancy and I were obviously direct operators, and when it comes to specific things like go-to-market tactics or, interviewing candidates for a given role, I think we tend to spike on that. And the other thing was we don't draw lines based on whose deal it is. So we all kind of on whatever balls appear across the portfolio. And we don't say, this is not Rob's deal, so he's not going to be part of it. We're very, very comfortable and willing to sort of do it across all of our companies.
I wonder when it comes to when it comes to managing the current portfolio companies, or I guess when you're leading deals, what are some how do you can we maybe walk through one of the deals that you have done most recently, so the audience can understand maybe the thinking framework that you are using? Because I think we touch about a little bit on it's all about the founder and making sure the fund is agreeing with which direction they're going. But I kind of feel like sometimes in early stage it's harder to tell where the founder wants to go, as from my angel investing experience, I feel like a lot of the founders are making drastic pivot from their existing product. How do you find the balance of both kind of can trust you build the trust with the founder to kind of feeling comfortable of the major adjustment that they're doing as a lead investor?
Yeah, I can take you through one very early stage investment that's certainly worked out for us. It's a company called OneScreen.ai, started by a wonderful guy named Sam Malik-Kijurnan, that was formerly of HubSpot. What OneScreen does, marketplace of out-of-home assets. So that's billboards, it's things in subways, it's any advertising you're going to see that's not on your TV, your phone, your laptop, your iPad. We were led to the deal in an interesting way. Originally I met Sam through an angel network that I'm part of in Boston called TBD Angels. And what appealed to me about that deal particularly was at Catalant, we were a huge buyer of out-of-home inventory. And we wanted to do more and more and more of it. But the existing major players, Clear Channel, Lamar, and JC and Outfront, have such convoluted go-to-market structures and sales and operational delivery teams that they... you really struggle to, one, buy more inventory, and two, track and assess the performance of that inventory. And so we knew that out of home was a top performing area of spend for us at Catalant, and yet we weren't able to do more of it just because it was so difficult to buy. So that led to me to think this should happen in a sort of technology driven marketplace. So Sam started building that vision along with his co-founder, Greg Wise, in kind of 2020. We met in the spring of 21. I first actually invested as an angel even before we had our first close at Asymmetric. And, I think what we saw very quickly was the customers were buying. We had only funded the company. I think we put in 2.6 million, and our co-investor Impellant put in 400,000. And even with that original $3 million, we were dealing with big companies. We had Aura Ring and Ramp and a bunch of others that were buying a lot of ads from us. And then over time, I think we migrated to less randomly finding people that wanted to buy out-of-home inventory and actually provoking more out-of-home purchases. The company now is relatively quite large and works with people across consumer packaged goods and B2B. And, it's a case both my colleague Nancy and I are on the board. We're heavily involved. We helped recruit a new CEO for the business. We've helped the company raise a lot of capital, and it's at the point where we're in the scaling phase now, and I think we're quite optimistic about where things are going to go on that one.
Totally. Basically, you mentioned that they would already have some big clients like a Ramp or Aura Ring at that point. So before you made, I guess the lead investment, the 2.6 million.
It was after we invested, but it was quite soon after, in a way that I think was surprising to me that we got such immediate traction. Made me feel as if there was kind of true commercial momentum to the idea.
I wonder, so for the repeatability part, since I feel like a lot of the companies would list a bunch of Fortune 500 on top of the deck to be hey, here are the people in our pipeline. How do you kind of validate if people would A, buy, and then B, having a repeatable purchase behavior around the product?
Look, I think part of investing at the early stages is you have to kind of do your own back the envelope ROI calculation to make sure it makes sense. So people will sometimes, this is all sort of B2B buying context, because obviously buying, soda or a taco doesn't have any kind of ROI. But at first you have to look at the small amount of repeat buy data you have, and you have to hypothesize, okay, we charge the customer $10,000. We know what their business model is. We know their costs and their revenue. Do we think that they may have derived an additional $50,000, $75,000, $100,000 of value from that $10,000 software buy? If they did, then they're probably going to buy more of it. If they didn't, they're probably not going to. And I think it's actually pretty straightforward over time when you talk to customers to understand, was this kind of a fever dream that they're going to do once, or something that actually has ongoing sustainable value that they're going to do over and over again?
Totally. I wonder, so when it comes to like going back to like the fundraising journey, like since I feel like when I guess like when you first like started talking to LPs, like what would be the initial traction that you get to keep pursuing this idea? Or like maybe you mentioned like you already have some really amazing funds as a backer. I wonder, since like there's like a rising amount of people that are trying to become emerging managers who are our listeners, and what would be your advice for like getting the first close, or like having the first group of like people who are either very establishing the ecosystem versus like, should you start talking to the institutional investor from like day one?
Yeah, look, I think when you're raising your first fund, it makes sense to spend most of your time with two groups of people. The first is funds or institutions that are focused on emerging managers that do fund ones and fund twos, and the second is high net worth. And I think the challenge with if you think of most of the dollars that are invested in venture capital and growth equity, they're very large commitments written by very large institutions into very large funds. $50, $100 million checks into funds that are $1 billion, $2 billion, $3 billion. That ecosystem has almost nothing to do with the $100 million or $25 million first time fund one.
Mm-hmm.
If you are somebody who's thinking actively about this, that probably means that you're not spinning out from a Bessemer or Greylock, an index. You're doing it on your own for the first time. You should spend time with people that are used to evaluating kind of the risk and reward associated with investing in an emerging manager. And you should spend very little of your time with big institutions that say, we want to form a relationship right now because we might back your fund 3 or fund 4, because you can do that. The most important thing when you're starting an emerging franchise is invest well in fund 1 and turn fund 1 into very good outcomes. And if you do that, everything else is taken care of. And if you don't do that, you're not going to have to worry about your fund 2 or fund 3. And it's a little bit like the same situation with startup founders, where you want to meet with the fewest number of VCs you can in order to successfully raise your round, and kind of each incremental VC that you invest with, that you invest your time with, that doesn't write a check, is in some sense not a very good use of time. I think that's broadly kind of the case while you're raising your first fund. People who might back you when you're at a $300 million fund size are not really a very good use of time at that point.
Totally. Would you emphasize on the DAC, or like would you emphasize on like just like having like a bunch of like first connections with like our first like coffee chats with people? I feel like I've seen fund managers who just like send a DAC to a lot of people and then close it. And then I've also seen people who are just like having a few conversations and then call it a day. I wonder, like when it comes to like fundraising for a fund, how do you kind of like have that like think about like creating the pipeline for yourself, as well as like the sales journey, as like, yeah.
Look, I think most typically you want to start with people that you know well, that have some sort of inside track with you. And you're going to, in most cases, probably get the best results from those folks. And then you can you think about it as concentric circles. There's people that are really, really likely to back you, that maybe you worked with in the past, or you worked for, or they're the founder of the fund or the company you worked at. Then the next degree of connection is classmates or the friends of the innermost circle 1. And as you work out, the ratio of why they're going to back you changes from that first innermost circle is only going to back you because they know you really well personally, and they're probably making more of an emotional decision than one that's really grounded in ration and logic. And then as you basically expand to each sort of incremental concentric circle, the ratio of why they're going to back you shifts from kind of emotion to rational and logic, until when you get to the extreme outside, it's people that not only you don't know, but don't know any of your connections, right? And those are the people that are most likely going to back you simply because of the data and the math. And those are the people that you're obviously quite least well prepared to work with when you're at your very beginning. And that's kind of the progression as you go forward. And I think that's kind of a good way to think about staging the process. So kind of build momentum with the friendlies and people that are going to back you emotionally. And then if you think about it, over the course of raising fund 1, fund 2, fund 3, fund 4, you layer in people with whom you have a way more kind of logical, rational relationship, and way less of they're going to back you because they just have an animal belief that you're going to do well.
For sure. I guess when it comes to like raising from like the people who trust you the most, like I want to talk about like maybe like building your personal board of advisors. So obviously you have built a successful fund one, and like when it comes to like raising over 100 million, I feel like it's really impressive. Like who would be like your first like contact when you were like sharing the idea of like I'm trying to build a fund, and like way before that, like how did you kind of like find the mentor or like people who are really believing in you at the very early on?
Well, I got very lucky when I was building this firm because it was my idea in some sense, but I really went out to get advice from a mentor of mine. He was the co-head of Bain Capital while I worked there, and then retired and basically started a fund family that includes a bunch of other assets. And I was having some iced tea with him on his back porch in August of 2020, and told him I was thinking about what was potentially next steps for me after leaving Catalant. And he said, well, would you ever want to put together a fund? Because if you did, I would want to do that with you. And so that was a situation where he really kind of spurred my thinking in a way that was definitely beyond where I was at that point about launching a fund. And having somebody in your life that has that kind of animal belief in you, and then is willing to kind of not only invest personally, but also help raise the remainder of funds from their kind of friends and contacts, that's kind of invaluable. And that's the kind of person that you really need if you're going to pursue something like this.
Totally. Hi, Linda. I want to quickly say hi, Brandon. Hi, Chloe. So I want to learn more about like, so when you find your mentor at like Bain Capital, like, since I feel like a lot of people would work for the same fund, but like, how do you kind of like establish a connection with like the people who are really important at the fund?
Yeah. Hi, Linda. Linda is one of my business school classmates, a valued business school classmate and good friend. Hey, Linda. Look, I think when you get to a new firm, there's a tendency for sort of more senior established people to take younger folks under their wing. And I think it's usually a mix. Like, I think a good mentor-mentee relationship is usually some amount of shared camaraderie and enjoying the same things and wanting to spend time together in a way that kind of replicates friendship. And then there's also implicitly kind of a value exchange for the mentor. And obviously I have a bunch of mentees today. It feels good to be able to give back and be helpful, but also I think the very active mentoring sometimes crystallizes thoughts you have in your head or helps you expand your own thinking about a topic. And then for the mentee, it would appear that you're capturing all the value, but I think you're also providing a valuable service for the mentor, and that they probably want to be able to give back to somebody that's kind of worthy of their time. And as a mentee, I always try very hard to be worthy of my mentor's time and make sure that they're not just hanging out with me out of the goodness of their hearts, but they might make more money or get to know a really interesting company or be able to kind of share a good investment with their friends. And it's not just kind of basically a charitable thing. And I tend to, as a mentor, also prefer when there's something in it that goes beyond just giving back. And it tends to be something where, I'm going to grow or develop in an interesting way as a person as a result of that relationship.
For sure. What are something that you would intentionally do before maybe like every meeting with the mentor, or like maybe someone did to you as like you as their mentor? What would be things that like you feel like, oh wow, this person did was like so amazing compared to like, a bunch of people just trying to pick your brain for something?
I think you want to be well prepared. I think showing up with a potential mentor with a really good list of prepared questions that are not things they could have found on the internet. So I think you want to do extensive research and be able to ask deep questions that are things that can only be shared in that one-on-one context. I think the best thing you feel as a mentor is when your mentee or the person who's seeking advice from you is asking questions that expand your own thinking, that they're questions that are so good that you sort of don't have a prepared talk track and you have to think about it in real time. That to me is really interesting. And when people ask questions like, how did you raise your first blank? As a potential mentee, that's the sort of thing they can read about. There's a lot of coverage online about how we got started at Catalant. And so I'm always disappointed when somebody books time with me and then the first question is, how did you raise your first round? Because, the answer to that is on the internet.
I wonder, so like, what would be like things that you would do to like maintain the relationship? On what cadence would you kind of like continue the conversation? Because sometimes if like a person who would just like ask you like so many times throughout the month, you will be like very tired. And in what cadence would you like suggest people to like maintain the relationship?
I think something like once a quarter or twice a year is usually best. I think that kind of hits the right cadence of stay in touch enough, but is kind of not annoying in any way. So I think that's usually best. When things get to be more common than that, I don't think it's quite as interesting as valuable. But I think more importantly, it's just that every interaction is really high quality. So when I think about pinging one of my mentors, it's never just for a catch up or a pick your brain. I send them a very, very specific question. And that I think that tends to resonate better with them than kind of the general would love to catch up and discuss versus here's the specific reason why I want you to spend time with me. And I think, with how busy folks are, that's just kind of the core respectful thing to do.
I wonder when it comes to like creating your own like sector to focus. So like you guys have like AI, software, marketplace, healthcare, and fintech. How would you like kind of like I guess like creating some sort of like content diet for yourself in these 5 different sectors to like keep advance your own thinking? Maybe like on a cadence you meet with advisors, or there are like 4 like publication that you read.
Yeah, look, I think if you're going to be an investor in a given space, you want to develop a set of beliefs or hypotheses you have about that space. And so take software for vertical software for manufacturing. One of my current beliefs is that it's very interesting if you can target large customers with high ASP products, and the sale and implementation cycle will be so complicated that if you're selling something for $9.99 a month, that you're probably never going to be able to outrun the gross margin kind of gravity of that business. Where we have had a lot of success in those spaces is companies that have 100 or 200,000 or $1 million average contracts. That's a relatively unnuanced one. Another hypothesis that I think is really interesting is companies that do something for you tend to perform a lot better post-sale than companies that help you or give you the data to be able to analyze, because that presupposes there's somebody on the other side that's going to use that tool to create business value versus things to just optimize or solve directly, because then that you can kind of reduce the dependency on the rest of the organization en route to creating value. And so basically, I know that I and all my colleagues have a set of hypotheses and beliefs about every space we invest in. We have ones for healthcare IT, we have ones for healthcare services. And when we meet founders, we're able to map that founder's value prop onto our existing beliefs about their space. And we can very quickly cross things off. If it's healthcare services, but the primary payer is Medicaid and value is really hard and there's lots of substitutes, we just won't take the meeting because we know that it's pretty unlikely we're actually going to do it. Versus it's this unique specialty within healthcare services, and there are very few people that do it, and it has this favorable payer mix that probably maps way better onto our existing view of the world.
Totally. How would you research for example, you use healthcare as an example, like how do you research each different industry to make sure you understand the unit economics and like the realistic of founder pulling off a certain specific domain?
A lot of it is working with our existing companies. I mean, most of what we do is in vertical software for sort of legacy industries, plus healthcare IT and healthcare services. And so every interaction we have with our existing founders, we're obviously talking to them about their company, but we also want to get to know about other spaces and understand how we can take the learnings and insights we have in one company and map them onto other investments we might make. And that I think speaking to people who are actually in the arena, particularly in the emerging company size, are usually kind of the best way to do it.
I wonder, like, when so I want to be mindful of the time, so I want to keep it short, as like we have a 1 minute fire round for you. So
Yep.
first question, what's your favorite book?
Oh gosh, my favorite book is "The Score Takes Care of Itself" by Bill Walsh, who's a longtime NFL coach, and basically says if you prepare accordingly and do all of the correct things, then the score takes care of itself.
I like that message. So who made the biggest impact in your career?
I think in my career, it's probably my family. I think they've been unbelievable supporters and cheerleaders. Whatever I wanted to do, I remember when I was a kid, I wanted to be an architect. Then I wanted to be an engineer. Then when I got to college, I thought seriously about being an engineer. I ended up obviously on business and finance. And at each turn of the road, it's not been a question of if I can be successful. It's been a question of how can they help me map the points, particularly in a more entrepreneurial way than you might have expected, given how I spent the first kind of 8 years of my life post high school.
Amazing. Who would you invite to your dinner party?
Oh gosh, definitely Tom Brady. Leonardo da Vinci is an incredibly interesting person that does not get enough sort of airtime. And then Elon Musk or Jeff Bezos, somebody who's built kind of a age-defining company as well.
Amazing. Where can we find you outside of work?
I spend almost all of my time outdoors, or I try to, hiking, playing golf, skiing, swimming, fishing. It's my goal to spend 365 days a year outside. It's just really hard to have a job if you're only outside. So kind of all 200 or 300 days, 250 days I spend inside are kind of not as fun for me as the ones outside.
Amazing. Well, Rob, thank you so much for coming on the show today.
My pleasure, and I'm happy that somebody mentioned Duke, my dog. He is also a car part of the story. That's often why we're outside.
Amazing. Okay, so ending.